Welcome back and thank you for joining us. What a busy news week we have for you in the days leading up to Thanksgiving. By the way, happy Thanksgiving to you and yours this year. We have big news, and that is that Liberty Reverse Mortgage will be ceasing reverse mortgage originations and also selling servicing rights. We'll get into the timeline and the details, courtesy of Housing Wire's Reverse Mortgage Daily and their editor, Neil Pearson. It says PHH will wind down reverse mortgage origination and sell their master servicing rights to Finance of America. Onity Group, which is the parent company of PHH Mortgage and its reverse mortgage division, Liberty Reverse Mortgage, announced last Tuesday the company has entered into what they call a strategic partnership with Finance of America to sell $9.6 billion in mortgage servicing rights, amongst other agreements. And one of the keynotes is that PHH or Liberty Reverse Mortgage will cease reverse mortgage originations in Q1 of 2026. So we're looking somewhere in January to March timeframe. The company was the fifth largest originator of HECMs or home equity conversion mortgages during the year ending in September. That's for fiscal year 2025. And you've seen them in our monthly Top 100 HECM Lenders report. That according to data from Reverse Market Insight, which does provide the data that we use to generate those monthly reports. In addition to obtaining servicing rights, Finance of America will obtain PHH's existing pipeline of reverse mortgages in the first quarter of 2026, and they expect that some of their U.S.-based origination employees will be acquired by Finance of America. So here's the scale of the servicing that is being sold to Finance of America. It will be up to 40,000 Ginnie Mae-backed HECMs. Now, the loans have a total unpaid principal balance of $9.6 billion at the end of September. So PHH will become a subservicer for these loans under a 3-year agreement with Finance of America, which they say has committed to minimum volume of new subservicing over the term of that agreement. This is not the first top-ranked reverse mortgage lender that Finance of America has acquired, either its operations, servicing, or origination platform. In late 2022, it was announced that Finance of America would be acquiring AAG, or American Advisors Group. Now, that was a big shift in our industry. Again, we'll keep you apprised of any changes as this story develops. In this segment, we're going to dive into the predictions of mortgage interest rates over the next 5 years. This comes to us courtesy of Yahoo Finance, but we're also going to look at the implications for the interest rate environment for HECMs or home equity conversion mortgages as well in the next 5 years. Yahoo Finance notes that now that we have the government shutdown in our rearview mirror, we don't know if there will be another one in early 2026, but now that that's behind us, we can begin to look at the long-term forecast for mortgage interest rates here in the U.S. because they are determined in large part, by the 10-year Treasury yield. Now, at Yahoo Finance, they designed a 5-year mortgage forecast, and it's built on 10-year Treasury correlations, which may give us some insight. They note that while mortgage rates are largely determined by the government bond market, mortgage rate forecasts can be derived from the 10-year Treasury note trends, and the two rates often track in the same direction, but there is a spread between them that they will account for. So as these mortgage rates go in the traditional market, oftentimes we see that track when it comes to the expected rate of the home equity conversion mortgage. Michael Wolff, a global economist at Deloitte, issued an update for the U.S. economic forecast, and he laid out their firm's Treasury yield expectations over the next 5 years. We expect the 10-year Treasury yield to hover near 4.5% for the remainder of this year, despite a softening in economic data and a 50-year basis point cut from the Fed in the fourth quarter of 2025. The 10-year Treasury yield begins to decline slowly in 2026 to 4.1% by 2027 and remaining there through the end of 2029. I want to stop and note that trying to predict long-term mortgage rates here in the U.S., whether it's 5 years or 3 years, is quite tricky and complicated because there are factors that are far outside of our control, such as economic confidence, or the U.S. debt and spending that are going to really determine how many people are looking to run to treasuries. And if people are anxious to buy up U.S. treasuries, then of course that's going to drive the yield down. But If the conditions are not so great here in the good old US of A, then there's going to be a premium demanded, which would drive those rates up. There's not much sunlight between the experts because Goldman Sachs also tracks with Deloitte, saying that the 10-year Treasury will hover somewhere about 4.1% through 2027. However, the CBO, or the Congressional Budget Office, expects that yield to be 4.1% by the end of this year, to 4% in 2026, and remaining near 3.9% through 2029. If there's one thing the experts can agree on, it's that we will not see 3% mortgage rates anytime soon, perhaps in our lifetime. Noting that the Great Recession and a global pandemic are rarely on the radar, and those drastic events are what it typically takes to move mortgage rates into those low ranges. With this in mind, reverse mortgage professionals like yourself watching will want to note that interest rates are likely not going to go down substantially, so don't bank on a significant percentage of your business being Heckham-to-Heckham refinances. Also, it's a good time to brush up and learn more about the proprietary products in our market. We have several that are very creative and some that are even for non-reverse mortgage borrowers. These products are very unique and well suited for aging borrowers, and it also protects them from payment shocks. So in this interest rate environment, I believe that diversification is in fact the most sound strategy. Last story for this week, the Trump administration is looking at another potential way to address the ongoing affordability crisis, and that is portable mortgage loans. We'll go into all the details of just how a portable mortgage loan works, what are its advantages, and the potential drawbacks. But this is not the first thing that we've seen when it comes to housing finance from the Trump administration. In fact, just recently, they floated the idea of a 50-year, yes, you heard it right, a 50-year fixed rate mortgage. Can you believe that? Now, we talked about some of the drawbacks of that as well. It would, in fact, only lower the mortgage payment for those who did get a 50-year mortgage, if they ever were approved and came into existence, by about 18 to 20%. Nevertheless, let's look at this proposal for portable mortgage loans. Yahoo Finance notes that the Trump administration is evaluating, there are no promises made yet, portable mortgages and what that could mean for homeowners. Essentially, a portable mortgage would allow a homeowner to take that low interest rate that they have today and the terms of the loan to a new property. And that can be helpful for those that have been locked in at a low mortgage interest rate and who may want to move. The question is, are they too good to be true, and would they even work? Now, if you have not heard about a portable mortgage here in the U.S., you can't be blamed because they are extremely rare. I've never seen one myself, but they are somewhat more common in other countries, such as Canada and the UK, but not here. Canadian and UK borrowers typically have fixed rate loans with terms that last only 2 to 5 years. So can you imagine your interest rates only guaranteed for a short window of time? That's why they need a portable mortgage. Now, that's very different from what we have here in the States with a 15 or 30-year fixed rate loan, which gives you a little bit more security on what that mortgage payment is going to look like, obviously. But in the UK and Canada, at the end of those short terms, they can pay off that mortgage or renew them and renegotiate a new term. Now, the shorter loan terms in Canada lend themselves to portability because borrowers can't lock in an interest rate that extends for decades. The big catch for portable loans here in the U.S. is that the mortgage balance must be paid off when the property is sold. That's because they are primarily funded by mortgage-backed securities, or MBSs. Those are all bundled into tranches of loans, and each mortgage is tied to a specific and, yes, individual property. So that generally would nix the concept of moving a mortgage from one property to another, and no two properties are identical. Advocates of portable mortgage loans note that it could be a great tool to unlock the frozen housing inventory that we see today, especially for homeowners who had pandemic-era mortgage rates and refinanced to as low as 2.5% to 4%. Yes, insanely low mortgage rates. Why would they want to move? They wouldn't, of course, because they would be jumping into a new mortgage loan that's much higher, at least twice as high as the loan they have now. The bottom line is having portable mortgages here in the U.S. would require two things. One is an act of Congress, and second is to have investors, the secondary market, endorse such a strategy, they would have to completely restructure those mortgage-backed securities to accommodate a portable mortgage loan. I just don't see that happening right now. But if this did come to fruition, let's just say it played out and all of a sudden we had portable mortgage loans, what would the impacts be for you as a reverse mortgage professional? Well, one would be that we would see more older homeowners, perhaps more inclined to relocate, and that could increase the opportunity for more HECM for purchase transactions.